Live on Facebook. Okay.
So Dad, is it raining over with you?
It is not raining at the moment, but it did rain quite a bit today, you know. Cats and dogs would be the appropriate, um, description of the rain today. So
it is currently pouring here, pouring down rain. So I actually moved all my plants out onto the porch. But if anyone's already live with us, just to give you a heads up, we start right at 4:30. But we like to log on a few minutes to let people get in and get live. So we're gonna start here in just a second.
And truth be told, if we log in at if we log in right at 4:30, you don't see us till about 4:32. So we we have to get there early and banter a bit just so it all works. If you're right on time, we want to be here for you. So otherwise the crazy world we live in here, this
I know
FaceTime Zoom world that is now our life. So it's kind of funny. Yeah. And although tomorrow is supposed to be nice. Maybe we'll even have a nice weekend. Who knows?
Hey, Dad, will you change to gallery view?
I am in gallery view.
Okay.
Yeah.
She's saying that we don't see split screen.
I'm looking at a split screen.
Okay.
But if we don't, then that's another issue. So.
Then maybe we need to change to the other view. Oh, she said it's better. So whatever.
Okay.
Do,
I toggled back and forth. We
are all good to go, apparently.
Yeah.
But yeah, so we are just about to get ready. Hey, Lynn, thank you for joining us. Hey, Katie, thank you all for being here. We are really excited.
And I'll mention a couple more times. The way this works, we don't know if you're here unless you say hi in the chat box. So find the chat box and say hi so we know you're here. It's just nice to see folks know who's coming in to visit. But but it's just the way Facebook works, you know.
Hey, so Kathleen, hey, Bill.
And if you're a shy person and don't want to say hi, that's okay too. So
hey, James, thank you for joining us. So we're going to get started. Welcome to our happy half hour, brought to you by Carolina Retirement Planners. My name is Sam Shoe-Cabbage, and with me, as always, is my dad, David Shoe-Cabbage, the president and founder of Carolina Retirement Planners.
Hey, everybody. So we're off to another happy half hour, and Sam.
Oh, and cheers, Dad.
That's right. Cheers.
Cheers, everyone.
What are you drinking now?
So today, my husband, I told him that I wanted some beer, and he brought me home from Trophy Brewing. It's called Trophy Wife.
Oh.
So I'm feeling real flattered right now. It's delicious. It's out of Raleigh, so it's a North Carolina beer.
I know it doesn't look like it, but this is herbal tea. But believe me, I'll have something stronger and a little later. I just find it's better to, as you know, kind of go easy while we're doing all this. So.
Hey, Neil. So my husband is on.
Oh boy. Hey, I see Michael's on here too. Good to see you. Sam, what is our topic today? And
I wanted to share my husband's news.
Oh, okay.
So my husband just started very recently at Waterline Brewing in downtown Wilmington. So he's no longer with Flytrap, but he's over at Waterline, and they have excellent beer. It's a really great spot.
Their Kolsch is to die for. If you like a nice, mild, you know, it's tasty but mild, and it's fairly low in alcohol, which means, of course, you can drink more. So their Kolsch is one of my favorites in town.
They do. I know that I had been there before they even opened, when it was an art gallery, and it's kind of an empty space, but it's a really cool space. If you haven't been out there, once you feel safe, I think that they're open right now and doing some socially distanced things, but once you feel good about going out and getting a beer, you should check out Waterline.
And they have a lot of outdoor space, and I think they actually have the farmers market there, a drive-by farmers market on Saturday morning. So
yes, they do. They're a really cool small business here. Oh, we have some new people. Hey, Jay and Martha. Dan, we miss it when you harass us in person too. And Brad and Martha.
Martha, Rick, and Jean. Jean's good to see you here, Jean.
And my dad mentioned this right before we started, but if you're here, the only way that we know that you're watching us is if you comment. So if you want to say hi, we'd love to hear from you. But just so you know, we can't tell that you're there unless you say something.
And I want a special shout out to Jean and Deborah. They referred a friend, a neighbor to us who I met with over Zoom today. It was good to meet some new people here. And I'll tell you, the Zoom meetings are going really well. But Sam, okay, what are we talking about today? How do we get our subject today?
So today, our topic was a question that was sent to us by Russell. He wanted to know about the 4% rule, and is it still valid today? Is that a good rule of thumb?
This is a good question, because I like the 4% rule because it has a great backstory, and it also, to me, shows what I think is wrong with the financial industry, particularly when it comes to retirement. So we're going to go over it and look at the backstory and things like that. And
yeah, Dad, maybe it's a generational thing, but I hadn't heard a lot about the 4% rule before I started in the industry. Maybe millennials, it just wasn't the same rule of thumb. So I'd be really interested to hear more about it.
Yeah, the trouble, millennials are so far from worrying about living off their pot of money in retirement. It isn't on their radar. So here's the thing. If you retire, you got a pot of money. The question is, how fast can I spend it? How much can I take out of this pot every year and not run out of money? Okay.
Yeah, that's the ultimate question.
That's the ultimate question.
Pretty much everybody.
And the gentleman that is perhaps most famous for an answer to this question, at least in recent years, is where is he? I'm going to pull up my screen. Is this gentleman here? We all see, you see this?
He's good looking, Dad.
This is a guy by the name of William Bengen.
Dad, I think that you had those glasses back in my baby pictures.
I am jealous of William Bengen for several reasons. Mm-hmm. The first of which is, boy, he looks even nerdier than I do. Okay, he graduated from MIT back in the late 60s with a degree in aerospace and aeronautical engineering. Okay, I'm also jealous because I applied to MIT and I didn't get in. I had to settle for Cornell engineering.
Oh.
But he got into MIT. He graduated with a degree, and then he actually went off, and for about 20 years, he worked in his family's soda pop business in New York. He grew up in Brooklyn, and his family had a soda business, and they sold it about 20 years later, and he moved to California, and then he went into finance, and he started working and he got his degree. And the year he got his degree, he wrote a paper for the Financial Advisor magazine. This was October of 1994. It's called Determining Withdrawal Rates Using Historical Data. Okay, so he went off and he did some calculations. You remember back about 93, those of you who were, say, in industry or engineers or whatever, that was when PC started to get fast. We got Lotus 123. Y'all remember Lotus 123 / file open? Remember everything was keystrokes, and we really began to be able to do fancy analysis easily. And he got the Ibbotson Guide to Returns, and he fed all this data into his computer, into a spreadsheet, and he calculated some stuff. And I'm going to go to the big board here to show you what he calculated here. So let me see if I can switch to the other camera.
Ooh, so fancy. While you're doing that, Dad, I just want to say hey to William, Mary, Thomas, Russell. Russell, thank you for your question, which is our topic today. Nina, Carol Ann, Bill, James, and Crystal. So we're so excited to have you all with us. Thank you so much for coming and tuning in. I know that most of you, many of you have already been here before for one of these. So we are very excited to have you. All right, Dad, I'm going to go off so you can.
Okay, so I can get. So what Bengen did, he said, you know, if I invested half my money in stocks and half my money in bonds, how much could I pull out? And let's look at history. He went and said, let's look historically what would have happened. So he started in 1993, and he went all the way back. He did a 30-year period. He said, well, people retire, they're going to live if you retire at 60 or 65, you might live to 90 or 95. So let's do a 30-year period. So he went from 63 up to 93 and calculated what the most you could pull out is. And then he went from 62 up to 92, and he figured out the amounts. And then the 61 to 91. And there was he did, I don't know, 56. He went back to something like 1928, I think was his.
Oh, wow. That was going to be my next question.
He did 50 some 30-year periods. Yeah. And he calculated all this, and he came up with the number 4%. If you pulled out 4% a year, you could, over all these years, be reasonably sure you wouldn't run out of money. Okay. Now, there's kind of two things wrong with this, or one is the time period. Think about it. All the data for this 4% rule came from before 1993. It didn't include the last decade. Remember, in the last decade, we had a big crash in 2000, went down by half, came back up. 2008, we dropped by more than half, came back up. So it didn't include that particularly bad decade, and it didn't include the really low bond rates we have now. Bonds are paying next to nothing. And that means, one, you're not going to have as much to earn in this portfolio. And two, it means if interest rates go up, bond prices fall. And by the way, if you go to rogo.com, there's a video there called Are Bonds Safe? That will explain all that. We may actually do that next week because that's a good topic too.
Yeah, the market looks a lot different since 93 than it did leading up to that, huh?
Very different. We had some bad years. And so the question is that valid? Well, a guy named Wade Pfau, who is a professor of economics specializing in retirement, in 2015, he did a study and he looked at this, and he did some fancier projections. You know, computers are even better than. He did some fancier projections out, taking all this into account. And he says that if you want to be 90%, not 100%, just 90% sure you won't run out of money, the most you can pull out is 2.16%. So the 4% rule is now kind of like the 2 to 3% rule, you know? Now, even Bengen himself came out with a new report in Financial Advisor magazine in May of 2012, where how much is enough. And he said there, quite frankly, I am at a loss for a meaningful technique to forecast the upcoming years. my historical deterministic approach doesn't seem useful. To a certain degree, the same considerations would seem to apply to stochastic methods like the Monte Carlo analysis. One day I'll do a rant and rave on the Monte Carlo analysis, and so even he later had his doubts. But here's the big picture. And this is one of the important things, if you're on this call and in or close to retirement, you need to realize. So let's say this is savings and this is your age. And you know, we all start working somewhere in our early 20s, and we start saving, and we kind of save up to retirement. And at that time, we usually put it in a mixture of bonds and stocks. We do this mix. The younger you are, the more stocks you have. As you get a little older, you put more and more into bonds. And you know, over the years, the market's going to go up and down till we retire. And during these savings years, you are a buyer. You go out and every month you put $500 from your into your 401k and you buy stocks.
Yeah, that worked really well for me back in March.
Yeah.
Back in March,
March was a good time. Well, that's the thing. When the market falls in half and you buy stocks, they're half price. They're on sale. And then when they come back up, you make out really well. So while you're saving, the fact that the market goes up and down can be to your advantage. They call this dollar cost averaging. You've probably heard that. That just says if I put the same amount in every month and the market falls, I'll kind of come out ahead, because when it comes back up, I'll do better. Now, what happened and what Bengen is saying up here is when we retire, we're going to do a 50-50 mix of bonds and stocks. We're going to do the same sort of strategy we had while we were saving. And we're going to be pulling money out of this. And you know, the market's going up and down. The trouble is, when the market falls and you're no longer a buyer, you're a seller of stocks. When you're a seller and the market falls, you've got to sell twice as many stocks to keep your basic beer budget, you know? And then when the market comes back up, those stocks aren't there to recover. It's called reverse dollar cost averaging. The thing that helped you while you were saving hurt you in retirement, and you just hope that back here, the end point where you die, you hope that the money goes further. But it's kind of crazy to do the same strategy when you're saving and a buyer as when you're a retired and a seller. But the financial industry was assuming that you would. There was only one way strategy to invest.
Yeah, I feel like you have a really good example that shows how poorly reverse dollar cost averaging can go for a person, don't you?
Well, if you've taken the classes, I've given classes at UNCW and Brunswick Community College these past 10 years. In that class, we have the two brothers example. And I think most of you who took the class will remember that. The good news is at the website rogo.com, we've actually put the two brothers example up in a 12-minute video. And I think we call it, Will I Run Out of Money? And
that one is really powerful.
It's one of those aha videos, one of the most important in the whole class. You should go back and review it. And if you are new to this website, this video, you ought to go to rogo.com, look for the Will I Run Out of Money video. That will teach you why this strategy doesn't work when you retire, especially if the market is high and falls early in your retirement. So what do you do to compound? What do we do to overcome this?
Yeah, well, that it sounds like what you're saying is, you know, even the guy who looked in 2015 and said it was a 2% rule, that perhaps looking at it in terms of how much can I take out each year from a typical portfolio doesn't, the whole hypothesis doesn't even stand pat anymore because of the volatility that we see.
Because of the volatility. And here's the other thing they don't talk about here. I mean, your folks are retired. Let's say you had $1 million here when you retired. And let's say you're doing the 4% rule or something and the market falls and crashes. You got this 50-50 back. And let's say you're down to $600,000. Are you going to still want to pull $40,000 out every year? If you watch the money dwindle, are you going to say, well, it's going to be okay because statistically, I know this 4% rule says it'll bounce back and I'll be okay. You know, emotionally, no one talks about the emotional aspect of this. We don't want to, depend upon some crazy gambling crapshoot for our retirement. Retirement should be based on math and not the market. So,
and what we find when people come in to see us is that no one's ever explained to them that their investing strategy needs to be different in retirement than it was while they were working. A lot of people aren't aware that needs to change.
Most people are just saying, hey, you're going to keep doing this and just hope it works. And the 4% rule says it'll work, and the 4% rule now maybe the 2% rule, and even Bingen has his own doubts. Now, what we do, and I think we did this, was it 2 weeks ago, Sam? We did how to manage your money in retirement.
Yeah, I think it was 2 weeks ago.
Yeah, so if you go back on Facebook, you can go back to past happy half hours. And what we did there is we took the money and we put some of it into defense, strong defensive players, things that won't lose money, which are largely CDs and things, and annuities, fixed annuities that are solid, can still have the potential to earn something, but won't fall. And then here we put this into the market, but even in the market, we use some fancier strategies to try to avoid big drops. And what's interesting is Bengen in his 2012 article, he said there's 3 things you might do to overcome this problem. The first one he mentioned was fixed annuities. So he's finally waking up to the fact that, yeah, maybe stocks and bonds in retirement are not the only thing you should have. He talked about reverse mortgages as being a second thing. That's a tricky one. It's right for some people, not for others. I often say it's kind of the money of last resort, or you got to really make sure you have the right plan, but it can work for some. And then he also said you should change the investment method from a buy, hold, stock, bond mix to maybe some fancier methods like we use in some of our strategies. So it's interesting that 20 years later, he's kind of come up with kind of what we're doing now. So that's a little bit here on the 4% rule, which is now the 2% rule. But really, even more important is to build a strategy that's different than it was here. So you don't need to depend on the gamble on the market to be sure you won't run out of money in retirement. You really want your retirement to look more like this, not a bunch of ups and downs. So, okay, so I'm going to return to the screen here and see if we can finish up with some things.
So while you're doing that, I want to say hey to a few people I didn't get to say hey to. Lynn, especially a shout out to Lynn. She is watching while she's donating platelets. So she's not able to drink any alcohol right now. But
She'll have a cookie later though, or a donut.
Yeah, so they might give you a cookie. Nadine, Kaylee, Matt, Rick, thank you for joining us. Tiffany, it's her first time tuning in. Thank you, Tiffany, and Casey. So we do have a few other questions, Dad, that just came in. And Spencer wants to know, how do low interest rates affect the 4% rule?
Again, the bond interest rates.
Hey, Miranda.
Bond interest rates mean that the calculations, the bonds were, for the most part, higher through most of Bengen's numbers years ago. In fact, they remember interest rates kind of peaked in the Jimmy Carter years in the late 70s. Now they're at really, really record lows. So again, you get less out. That's why the subsequent studies said less. The other thing is the risk of your bond values dropping if interest rates go back up. And again, I think we'll cover that next week in our happy half hour. We're going to do Are Bonds Safe? And we'll help teach some of those principles in a sort of fun, enlightening way, hopefully, once again.
Oh, I know that is that's a question that we get a lot as interest rates are getting lower and lower. What does that mean? What does that mean for building a safe portfolio? So this question, Jean had a question that I think that I want to mention, but we may want to address at a later happy half hour. Jean wants to know, why do annuities get a bad rap? What is the primary difference between fixed and variable annuities?
Okay, that could almost be a whole presentation in itself.
Yeah, now that I see that, I think that might be a really good happy half hour.
That might be a good happy half. Let's hold that one off till we can do it justice, because we only have, we like to keep it to half an hour. We got about 6 minutes left. Do we have any little questions we can answer in that time?
Yes, we do. So so one of the things that we've done is ask you to send us in questions and potential topics, and we haven't gotten to cover all of them. We tried to, but I wanted to pull out a few questions that came in this week that I thought were really cool. If I can find them, here we go. The first question is, have there been any changes to how we can contribute or withdraw in an IRA due to the pandemic? And should we consider moving our standard IRAs to Roth IRAs during this unsettled time?
Well, there haven't been any changes for how you can contribute, but what about withdrawals, Sam? Has that changed?
Yeah. And that question came in from Dan and Barb. So there are some changes to how you can take money out. So this works for all of your retirement accounts, your 401ks, 403bs, IRAs. If you are under 59 and a half and you try to take money out, one of the things that they do is they ding you with a 10% penalty. They say, we've been putting this money away for retirement. You're not supposed to take it out now. There are a few exceptions, but for the most part that you have to pay a penalty. As long as you qualify, you can take what they call a CRD, a corona-related distribution, or coronavirus-related distribution. So as long as you either got the coronavirus, your spouse or family member got it, or your income was affected, you lost your job, you got your hours cut, if you were affected in some way, they've made an exception. In 2020, you can take out up to $100,000 out of your retirement account. They will not penalize you the 10%, but you do have to pay normal income taxes on it. That's, you can't get around that.
No way around that.
If you would like to, instead of paying your taxes all at once, they will let you spread them out over 3 years. So to give you a little bit of a break, if you have to take that out, they'll also let you pay that back to your retirement accounts within 3 years. And then they'll reimburse you for whatever taxes you did pay. So we don't ever recommend that people do this. It should be a last resort. But even yesterday, we had somebody shoot us an email because their 40-year-old daughter had become unemployed and was trying to figure out how to access the money in her 401k. So we know that people are struggling out there right now, and that is an option for you.
Yeah, it's something you don't want to do, but right now we're all doing a lot of things we don't want to do. So sometimes it's a necessity. You got a question on your situation, give us a call, or your kid's situation, and we can help with that. Now, as to should you do Roth conversions, remember the number one rule with taxes is always pay taxes at the lowest rate. And for that reason, this is a good time in two categories. One is you're probably earning less. If you're working and you've been laid off or your job or your income, whatever, is down. I know I know Corning has cut salaries by 10% and things like that. This is, if your income's down, you have more room to pay tax to do Roth conversions with at this, open up space in your tax bracket. So also, you're probably, if you're like I know a lot of our clients, they've canceled trips to Europe and various places this year. So you may not be taking as much out of your savings to go on trips. Time to use that space to do Roth conversions, pay it at the lowest rate. Also, taxes are due to go back up in 2016, January 1st.
2026.
Yeah, 2026. Yeah, it was a decade here or there, you know. So it's like
back to the tax rates of 2016.
Yeah, so they're going back to higher tax rates, and so now's another good reason to do that. And at Rogo, there's a video called "Which Earns More, an IRA or Roth IRA?" I'll show you why it always makes sense to do that tax-wise. There's one on how to do Roth conversions. There's the Jack and Jill example, which is my favorite example, is there, and that'll teach you a lot of things too. So,
all right, Dad, I'm going to interject here real quick. I have one more question that we really wanted to cover, and we're going to do it quickly. Martha had emailed us and asked if we could discuss the pros and cons of waiving the required RMDs in 2020 and what the tax considerations would be. If you remember, whenever Congress passed the CARES Act, one of the main provisions that's really exciting is that you do not have to take, you are not required to take your RMDs or required minimum distributions this year.
So here's the thing there. If, you know, when you get to 70 and a half, now 72, you've got to take out about 4% of the money every year, and it keeps getting bigger. And you can't convert that to a Roth. You have to take it out, pay tax, and, you know, you can put it back into savings, but you have, boy, this year you don't have to take it out. It might be a good year for you to say, wow, I'm going to take that RMD that I would have normally had to take out, and I'm going to, and pay the tax on it, I'm going to convert that to a Roth. So you should think about, you should think about, if you don't need the money to use this gap you've got in your RMD years, and do some more Roth conversions, pay taxes at the lowest rate, get it in the tax-free world. So we're just about at time.
Yes, so we are here.
You know that we have if you submit a question during the week, we'll put your hat in a drawing for wine. We've added something this week. If you refer someone, if you send someone a link or to the video to this next week's happy half hour, we'll also put your name in the hat. Now, all you have to do is send us an email, say you referred someone. If you want to give us them who it was, that's great. If you give us their email, we'll put them on our mailing list. But if you don't, that's fine. It's the honor system. You say you referred someone, we trust you, and we'll get your name in the hat as well. So another way to get entered in next week. So who's our winner?
All right. So everybody who sent us a question this past week, your name is in my hat. Since I'm not going to the beach that much, now my beach hat has become the drawing hat. So our winner today is Tallulah and John.
Oh boy.
So congratulations, Tallulah and John. Thank you for sending in a question. We will be in touch to get you 2 bottles of wine delivered to your house. Did we say that? Did we say what the drawing was for? If you win like Tallulah and John did, we will ship you 2 bottles of wine directly to your door from a local bottle shop called Fermental. So we're happy to support small businesses and help you take the edge off a little bit as well.
So, and again, send us topics you might like for us to talk about as you know, the questions, and or refer us, and just shoot us an email that you did. And let us know what you think about this. We're having fun with it. It's been good. So
Miranda, who won last week, she said, thank you so much for her prize. So Miranda, I hope that you're getting to enjoy your wine right now, or whenever is good for you.
Thomas asked how my vacation was. It was too short. but it was fun. It was fun.
Figuring out where to escape to next.
And I don't know if we said hi. Yeah, we said hi to Bill, I think. So
Hey, Bill.
it's great to have you all here. And, you know, we will see you same time, 4:30 next Thursday. Are bonds safe is I'm going to be the topic. And we'll answer some more questions at the end if we have time. And it's been fun, and we'll see you in a week.
Cheers, guys. Cheers, Dad.
Cheers.
We'll see you next week.